Bitcoin's supply shock is already here, and it's accelerating faster than most investors realize. Supply is drying up. Institutional demand is setting records. And every key on-chain metric is screaming one message: scarcity. Let's break this down. In April 2024, Bitcoin underwent its fourth halving. The block reward was cut from 6.25 to 3.125 BTC, reducing the daily issuance from around 900 coins to just 450. That's less than 0.84% inflation annually. For an asset with capped supply, that's an extinction-level compression. And the effects are compounding by the week. At the same time, the demand side of the equation is going parabolic. Spot Bitcoin ETFs, led by BlackRock's iShares and Fidelity's Wise Origin, have exploded in popularity. Just this week, they saw over $1.1 billion in a single day of net inflows. Total year-to-date inflows exceed $14.9 billion, and cumulative inflows since launch are pushing $50 billion. This isn't retail hype. This is institutional firepower. So what happens when a hard-capped asset sees a demand flood from pension funds, asset managers, and sovereign allocators? Price doesn't just rise, it can dislocate. And we're already seeing the signs. Exchange reserves have dropped below 2.44 million BTC, the lowest level since 2018. That's just 13% of the total circulating supply. More Bitcoin is moving off exchanges into cold storage or custody solutions, reducing sell-side liquidity. That's a classic prelude to a supply squeeze. Meanwhile, on-chain data confirms this hoarding behavior. Long-term holders now control a record percentage of the supply. Over 70% of all Bitcoin hasn't moved in more than a year. That means it's locked. Inaccessible. Off the market. When you zoom in visually, it shows the exchange balances chart collapsing. And highlights long-term holder supply at all-time highs. Institutional ETF inflows surging. Now add the macro layer. The US CPI is currently tracking at 2.4%, down from prior highs. But don't be fooled, core inflation remains sticky, and the Fed hasn't committed to cutting rates anytime soon. The 10-year Treasury yield is holding firm at 4.4%, choking traditional risk assets like tech stocks and small caps. But Bitcoin? It's holding firm above $117,600, recently touching a new all-time high, signaling that the supply squeeze is already in motion. Realized volatility is spiking, suggesting that a bigger move is imminent. And historically, Bitcoin's largest post-halving rallies begin not instantly, but 6 to 12 months after the event. That puts us squarely into a prime breakout window, Q4 2025. Let's run the numbers. Post-halving annual supply is now around 164,250 BTC. If ETFs are absorbing 50,000 to 70,000 BTC per quarter, and miners are selling roughly 20,000 BTC per month to cover costs, that leaves very little float. The remaining BTC? It's being absorbed by long-term holders or moved to deep custody, likely not coming back anytime soon. This is the formula for a parabolic supply squeeze. Add to this the psychological layer: as price begins to rise and media coverage intensifies, FOMO activates. Retail rushes in. Institutions chase momentum. And the small available float evaporates in a frenzy. This isn't theoretical. This is Bitcoin's historical playbook. 2013, 2017, and 2021 all followed this same rhythm. Halving, dormancy, supply crunch, explosion. Stick around, because here's what we're watching next. A potential breakout above $120,000 would invalidate the consolidation thesis and spark fresh inflows. But a rejection there could delay the move by weeks. Either way, the supply structure is now so tight that the pressure has to resolve soon, and it's almost certainly upward. So what's the takeaway? The supply shock isn't coming, it's already underway. And if you wait for the headlines to tell you it's happening, it'll be too late to benefit. If you found this breakdown helpful, hit subscribe please. No one ever seems to subscribe. Drop a like, and turn on notifications.